Tammer Kamel, welcome to Built to Sell Radio.
Well, thank you, John. It's delightful to be here.
Abraham and you, your partner, Abraham, started this business, Quandl. Can you take us back and tell us the sort of story of how this thing got off the ground?
Yeah, for sure. So a long time ago, getting on 12 or 15 years ago now, Abraham and I worked together at a hedge fund in Tokyo, of all places, where we did a lot of quantitative analysis. And, you know, these days you might call what we did back then data science. That term didn't get used as much back then, but we were data scientists, especially me. Abraham did a lot of trading as well. And in that world, and in the worlds we were in at that time, data was a precious commodity. It always has been, always will be. You know, on financial markets, information is paramount, right? And so, you know, when you're making investment decisions, you need the best data, and you need it structured and organized, and you need to be able to analyze it, and you need to be able to work with it effectively. And what we realized at the time was that data on the internet, there was lots of it. When I say data, I'm talking about numerical data, numbers that speak about the state of the economy, the state of the oil, state of inflation, the state of unemployment. That data is out there. There's tons of that data available, but it's a mess. It's hard to find. It's hard to get into the system you want. You can pay third parties a lot of money to get that data for you. And so our brainchild at the time was try and build some sort of consolidating platform that made all this data available and accessible to someone who wanted to use it. And we had audacious ideas back then. We used to pitch Quandl as being the Wikipedia for numbers. So we were going to do for quantitative information what Wikipedia had done for qualitative information. We're going to have this one website where I don't care what you need to know. If it's quantitative in nature, we're going to deliver it to you.
So you and Abraham started. Where did you guys get the startup capital?
So we started with our own blood, sweat, and tears, and then we did a classic kind of angel, friends and family kind of money, although there were actually no friends and no family. But, and the reason for that, by the way, is I didn't want to have to go back to friends and family 2 years later and say, I've lost all your money, right? So acquaintances, shall we say, where we had made a positive professional impression in the past, and they were willing to bet $20,000 or $40,000 on what we were up to, and we must have raised, I don't know, $300,000 or $400,000 in that way, which for two people with a couple employees, that lasted. We got a couple years.
So did you and Abraham just split the equity 50-50 and then raise some money to the angel?
Almost. I had done a lot of work or some work on the product before Abraham jumped in. So that left me with a slightly larger share than he had, but we were essentially very close to 50-50.
Got it. And then I'm assuming, can you roughly estimate how much of the company you would have given up in that angel round?
How much did we give up in the angel round? Probably maybe 20%.
Oh, wow. Okay.
Yeah. Well, we gave up plenty more along the way, for the record. But at that point, we still probably owned 80% of it.
Okay. So you got some cash. And I have to ask, when I think of data and investors and their appetite for data, in particular institutional investors, I go straight to Bloomberg. I go to this is the 800-pound gorilla. They've got all the information. If it's worth having and there's a market for it, it's in the Bloomberg terminal, and they paid a truckload to subscribe. So, how is what you were envisioning different or going to compete with the 800-pound gorilla in the market, Bloomberg?
Well, so let me talk about theory and then the reality that smacked us in the face on that front.
Yeah, sure.
We're right on the money here. So we were on this mission to we used to say this a lot. We're going to democratize the data world. So we were going to make it so that Bloomberg couldn't have this monopoly anymore. And we were going to make it so that anyone could buy and sell data on our platform. The reality we ran into is that, so I mentioned this analogy with Wikipedia. The big difference between numerical data and qualitative information is that qualitative information, so Wikipedia has an article on the history of Rome. Somebody had to write that article once. If I want to have a wiki site with the current price of oil, somebody has to update that every day or every hour or every minute, right? So it's way more difficult to maintain an article or a piece of content on something as dynamic as data, because it changes constantly. Otherwise, it's useless. If it's not being updated, and so the democratized utopia we envisioned, where everybody's uploading data, it just doesn't. Nobody has time or inclination to volunteer and update 100 million time series that Bloomberg has. So the reason Bloomberg is so successful and so valued is because they do all this. It's all there in one place. So this actually segues nicely into our how our business evolved, because it became apparent to us that the effort to achieve this Wikipedia for numbers is probably impossible. You can't do it by some bot scraping the internet for technical reasons. It's just too difficult, a technical problem. And you can't crowdsource enough people to do all this work. It's just too much work even to crowdsource. So we had to narrow our ambitions. And we're bumping into Bloomberg more and more, by the way, at that stage, where we're trying to sell something to somebody and they said, well, we already got Bloomberg. Well, we're good, right? Even though I had some aspects of what we were doing were better than Bloomberg, but no one's going to, very difficult to get someone to unplug the Bloomberg in favor of your thing because it's a little bit cheaper or has a little bit better API, right? So we realized if we're going to compete with someone like Bloomberg and others, big gorillas in the space, we better be offering something they don't have. And this is when we landed on this idea of alternative data. And this is a term used kind of well understood today in the financial market, but alternative data is data that is relevant to a professional investor, but doesn't come from the financial domain in the first place. And in the world we live in today, there's data kind of being created everywhere all the time. It's ubiquitous. It's a byproduct of things that are happening in every company. I often say, if you could just tap into every database in the world in some magical way, you could know the state of the global economy in real time. You could know, there's nothing you can't know.
Well, there's one example that I was reading about in prep for this interview. I think it was an article about Quandl in the Financial Times, and it described the use of aircraft lease information as a predictor of M&A activity.
Yeah.
Can you walk us through how aircraft leases has anything to do with M&A, or how it would be sort of a canary in the coal mine or bellwether to M&A activity?
Yeah, it's a great example. It's a great example of alternative data. So here's the thing with how that works. There's all these airplanes flying around, and they all have transponders on them, and they're all broadcasting exactly who they are and where they are. They're doing that by law. And that data is in the public domain. It's radio waves. So that data is being picked up by transmitters all over the world. And so if you kind of work with the right people and cobble together the right databases, you can actually track the movements of every plane in the world at all times. And that's
kind of freaky.
Yeah, it is. Now, secondly, if you happen to know who owns these planes or who leases these planes, you can start inferring things about business activity. So, if you see a plane going from a small city that happens to be the headquarters of a big company, and it's going to another small city that happens to be a headquarters of a big company that competes with that company, right? You can start saying, oh, these guys are having some pretty high level discussions about something, right?
That's so cool. And would you know that it's a private jet versus like a United flight? Would you know that?
So the thing is,
that's crazy.
So it's pretty neat. It's noisy. It's never definitive, right? Because you don't know who's on the plane. You don't know if the CEO's flying over, or you don't know.
But if it's the private jet, you'd assume it's somebody
important, right? So here's the thing with that particular data set. It never tells you anything definitive, but it gives you some hints, right? So if you're a professional analyst watching a particular space and you already suspect that something's happening, this might put you over the edge to say, aha, I knew it. Something's going down here, right? But just zooming out, this is a great example of alternative data because you're not using any data that derives from the company or from Wall Street or from the government.
It's not illegal. You're not stealing this. It's all in the public domain.
Exactly. And so that's the data. We actually offered that on Quandl. And the beauty of that is all my competitors that whose lunch I was trying to eat, they don't have that. Bloomberg can't offer that. S&P didn't have that. Refinitiv didn't.
But presumably they could have, though. Again, to your point, it's in the public domain. There's no way you could protect that if you Quandl offered it. Presumably, if it was a sexy enough product, all the Bloomberg customers are asking for it. They could have knocked it off, couldn't they?
Yeah, no. There's not, and same goes. We had a bunch of really smart, innovative data products, and you're absolutely right that they could have. And we'll probably get to this, but one of the reasons we eventually got acquired was because we had proven to the world that we were damn good at finding these data sets, because you have to, these things don't fall in your lap. You have to go out in the wilderness and find this data and figure out how am I going to make this data relevant to a professional investor. That is not an easy thing to do. Most data is just crap. It's noisy. It has nothing to say. You have to be statistically rigorous. You have to have understanding of markets. You have to be able to organize and structure it. So I'm not suggesting for a second that we're the only one who can do that, but we were damn good at it.
Yeah, I love this. This is so cool. Okay. And so the business model evolved from this, my words, not yours, harebrained idea of Wikipedia for data to eventually really a competitor to Bloomberg offering alternative data sets that were not available in Bloomberg and some of the other financial information products. Is that right?
100%.
Okay. And so the business model there is selling, as I understand it, subscriptions effectively to these institutional investors. Walk us through that model.
Yeah. So another nice thing about data is for an investor, it becomes addictive. If you're telling an investor something that gives them an information advantage over the market as a whole, it's invaluable. It's incredibly powerful, right? Because it leads directly to better investment decisions, which leads directly to more profit. So our model was actually, I used to joke, we're a bit like a drug dealer because we want to get our customers hooked on our data. And when they're hooked, we know we're going to get that renewal. And so we had very low churn. The only time we'd have churn is when circumstances beyond our control would make the data less effective, which sometimes happens, right? I can talk about examples of that.
Was your product at the data set level? So I want to subscribe to the private jet feed, but I don't want the oil price feed. Or was it like an all-in-one package?
A la carte. So you buy what you need. And the reason for that is, we charged a lot of money for.
How much did you charge?
Price points could range anywhere from $25,000 a year to $250,000 a year. My favorite is, we once sold a data set where we would give you one number a day, and it was $120,000 a year for one.
What was the number?
That's 16 bits of data. It was an amazing number. It was how many Tesla vehicles were hitting the road every single day. Back when nobody knew.
And somebody paid you $120,000 for that.
But you know what? They made 10 times that on what they could do with that information.
How?
Well, because I guess we're in 2016 or 2017. Nobody had any idea how good Tesla was doing. No one had any idea. Were they killing it? Were they selling lots of vehicles? Were they not selling any? Nobody knew. We knew. It's an interesting other example of alternative data. We knew because we partnered with insurance companies. So we went to insurance companies and said, look, I don't want to know any personal information about anyone or anything you do. I just want to know how many policies you're writing on Tesla vehicles. Just tell us that. Just tell us one number every single day. How many policies you write on?
And would they give you that for free?
No, of course not. No. We shared the revenue with the owners of the data, for sure.
Got it. And for that Tesla product, did you have one customer?
We had a bunch of customers.
Okay. Did customers ever ask you for exclusivity?
Sure.
How did you deal with that?
there's nothing stopping us from giving a customer exclusivity. So the way we do this is we would have for any data set we offered, we would have some idea of how many sales we aspired to make, and thus how much money this data set would generate for the company. If someone wanted exclusive and they wanted to, kind of buy all 12 licenses we intended to sell, no problem.
So you would charge them basically the entire projected revenue for that data set. You can give them a discount. That sort of logic.
I mean, we're a pragmatic small company trying to add revenue, right? So if someone gets really excited about a data set and they want to pay up for exclusive access to that, I mean, that's a win for us too, right? Because then that's, less sales and marketing we have to do and one big check, and we can sort of move on and work on the next data set.
How did people pay? Was it all up front? Was it monthly over time? Like what was the cash flow of the business?
Depending on the data set, we would offer annual or monthly payment structures. Most customers.
Annual was paid up front?
Yeah. Oh, yeah.
How come you needed money? Because I understand you went through a series of VC venture capital raising. I think in total, I read somewhere you raised a total of 20 million or 17 million. It's a significant amount of VC money. Yeah. I'd be curious, like, what triggered the need? Because from what I'm hearing you say, at least from a layperson's perspective, I feel like it's a cash flow positive business. You're identifying data sets. You're buying access to them, maybe on a revenue sharing agreement. You're getting customers to pay up front, at least some of them. So why the need for VC money? What was driving that?
So there's two things that are expensive to do. One is there's a substantial investment you need to make in the technology platform to deliver this data. If you're selling data like the one if someone's paying you $120,000 for one number a day, you had better deliver that number at 8:02 a.m. every single day and never screw that up. And when you're doing that, you've made that promise to hundreds of customers across thousands of different data products. You need some seriously good technology to keep that promise. So there was a non-trivial technological component to what we did. Secondly is the data science that has to be done to make these immediately actionable data sets available to customers is also non-trivial. There's a lot of data, what we call data wrangling, sort of grunge work, get the data, make sure the data gets in from the customer, from the partner every day. Then we have to clean it and validate it and verify it. And there's a ton of R&D that goes on to find a good data set. I put it to you that for every data set we released as a product on Quandl, we would have examined 50 to 100 data sets and put them through a process. Wow. Because it's a needle in a haystack. Most data doesn't tell the market anything it doesn't know already.
Interesting. Okay, so there's a ton of upfront work which needs to be financed. Walk us through the financing journey that you went through. You mentioned the $300,000 for 20% for the friends and family round, or acquaintances, we'll call it. Then just walk us through what other financing the company had. We raised a little bit of money, like I say, from the angels, and then we raised probably $500,000 from a pseudo institution in Toronto in, I want to say 2012-ish, 2011, 2012. And then we went to the Valley in 2013, and we pitched a lot of VCs, and we told them at this point we were still telling our take over the world Wikipedia for data story, and we eventually got some interest from a couple VCs in 2013, and eventually closed a $5 million round with August Capital. And on the back of that money, we really were able to accelerate things. But at this point now, remember, we're still chasing the audacious dream of Wikipedia for numbers. It was somewhere midway, a year into that, where the reality of the overly ambitious, that overly objective set in, and we kind of, you can call it pivoted if you want. I call it zooming in. We got more focused, right? And by the time we went out for a Series B, which was 2015, we had not only had we adjusted the business model, but we had traction. We had customers buying data off the platform, and we had
third parties wanting to be on the platform. And this is a huge breakthrough for an aspirational marketplace, because when you have action on both sides, when you have people who want to consume the product and suppliers who want access to those people, you're in a good place. And it was on that story that we raised Series B in 2015, and that turned out to be the last raise we would do before we sold the business, I guess 3.5 years later.
Okay, so with regards to the $5 million that was led by August Capital, just walk us through, if you could, what you provided them. I mean, do they have preferred shares? Was there any liquidity preferences? Maybe just anything you can share as it relates to that raise.
No, both August Capital and our subsequent partner, Nexus Ventures, were very straightforward, very fair, no nonsense, no silliness, very clean term sheets from both of them, where they just took an equity piece in exchange for the money with no.
How big an equity piece? How big an equity piece did they get?
I think we gave up a third of the company in Series A and probably another 20% in Series B, something around there.
Yeah. I guess one of the things that I wanted to ask you, just given how much experience you've had raising money, institutional and kind of acquaintances and so forth, is like kind of what did you learn in the process of building this company as it relates specifically to raising money? And I guess I'm asking this because a lot of the listeners of this show are on the fence when it comes to, would I rather own a big slice of a small pie or a small slice of a big pie? And they go through, I think, machinations, iterations of that, where they're like, you know what, I want to be the master of my own destiny. I want to own 100% of the shares. And if that means I grow a smaller company, so be it. And then other times, I think they hear about these big capital raises and they think, man, I should be more aggressive. I should be raising money and shooting for the fences, so to speak. Yeah. And so I'm asking you, to the extent you're comfortable sharing, sort of like lessons learned or things you might do differently or ways you might approach that process differently, if you could kind of rewind the clock and sort of have a mulligan.
So we had superb investors. Trip Jones at August Capital and Naren Gupta at Nexus were just superb supporters of our business. I mean, they're richly insightful, intelligent, always helpful. But in spite of all that, there is still a pressure that comes from having professional, third-party, institutional, unemotional investors as part of your business. At the end of the day, you got to perform and you got to deliver. And I think that's kind of the trade-off you make when you choose to take venture funding. And I think there's always a little bit of grass is greener syndrome, right? It always, when you're, for me, having gone through a venture experience, I do see the appeal of bootstrapping a business and saying, look, I'll never take another dollar from anyone. I'm going to bootstrap this thing and it's going to be my lifestyle business and I'm going to call 100% of the shots. And, but then there's all totally different pressure that comes with that because there's, could be $0 in the bank account, right? And you better make your payroll next month, right? So I've only been on one side of that fence. And like I said, I was blessed with two exceptional venture capitalists as partners. So that helps a lot, right?
And I'm not a VC. I don't play one on TV or the internet. So I'd be curious to know your thinking here. But from what a little I know about the VC world, they're sort of, again, a swing for the fences kind of community. So if you take 10 investments, one of them is a huge home run. Maybe one or two are kind of what they call walking dead, which they're never really going to be huge home runs. They're just not, but they're not dead. And then 7 or 8 are dead on arrival. They run out of cash and they get written off. Yeah. What my understanding of VC investing is that, to be in that first category, the kind of home run, hit the lights out, it needs to be like for every dollar they put in, they get like $100 out or $1,000 out. Did you feel that pressure to deliver crazy returns, to be that home run, that Cinderella story for the VC? Did you feel that pressure to kind of swing for the fences?
Yeah, for sure. But they make no, I remember Tripp telling us the day he made the investment, he goes, this is what we're looking for. So it's not like
what was he
10x. Like he
10x.
Like that in all their investments, and for exactly the reason you note, right? 7 out of 10 of their investments are going to give them 0. So if they want to return 20% on the fund, they better have a few 10x's, right? So there was never any ambiguity about that from day one, and so of course, yes, for sure, there's this pressure to swing for the fences. And I'll tell you an interesting kind of conflict of interest is too strong a word, but imperfectly aligned incentives is how I would describe this. At one point with Quandl, we were doing really well to the point that, we could approach an exit, which we'll eventually talk about, which would leave myself, my partner, my employees, my investors very happy. But it wasn't a unicorn kind of outcome, a 10 or 20x. And so I'm sitting here as CEO, and I've got some decisions to make about just strategically, how aggressive do we be? Do we kind of take risks that would possibly diminish the current value of the company in going for that home run at the risk of maybe having less than we have now? Or do I be a little bit more conservative to preserve the value that I've created? And the truth is, the VCs would rather you swing for the fences. And if you're a 0, you're a 0. But for me, obviously, I don't have the diversified portfolio of 10 or 20 investments, right? I have one. And so, I say all this because that's the reality. In a day-to-day, they were, and I think this is best practices in VC land anyway, but not all VCs do it, is they have a founder's first mentality. So Tripp Jones especially, he had my back, he had Abraham's back all the time, right? And was supportive of the realities on the ground. And he knew very well the dilemma I had with, do we shoot for the moon, or, we content with having hit a double and so anyway, but yes, so to your point, yes, it's a thing, right? You take VC money, you got to swing.
Yeah. Can you walk us through an example of that in your business where the safe and prudent thing to do would have been X and the swing for the fences decision would have been Y?
Well, so I'm not sure what the swing for the fences Y would, but here's the thing. When we built this alternative data business, it was clear that this thing could make tens of millions of dollars. But
in revenue or profit?
Pardon? Oh, revenue.
In revenue?
Maybe 10, 20, 30, maybe 50.
Where were you at the time, roughly, that you're at this epiphany? How much revenue, ballpark?
Oh, when we realized that how big it could be, we're probably at a few $1 million, maybe 5. Right?
Okay, so you're 2-3 million in revenue, and you're like, this thing could be 10, 20, 30 million.
Yeah. Oh, yeah, for sure. But at the same time, we realized it's probably not going to be 500 million. And that is a problem for a VC, because if you want a multi-billion-dollar valuation, there's got to be hundreds of millions of dollars of revenue, either in reality or a pathway there, right? So the dilemma was, look, we built a good niche business. So the question that we had was, look, do we, should we kind of say, well, whatever, we got that, but really we should be trying to rethink everything to find a business that can do $500 million and, and then what we make now becomes a rounding error on that. Now, as it turned out, we didn't go chasing that unicorn. We kind of stuck to our knitting and grew this business as best we could. And then, of course, eventually we led to an outcome, an acquisition,
Yeah, let's talk about that. So how, I'd be curious to know, was there sort of some triggering event that caused you to decide to sell the business, or a straw that broke the camel's back?
So it was really the macro environment. So in 2018, we'd reached a point where what we were doing, this alternative data idea, was kind of hot. There was a lot of investors were excited about it. That is to say, professional money managers were excited about it. And all the incumbents, bar none of the big incumbents, were all spinning up alternative data divisions. They were all jumping on this bandwagon, and rightfully so, because there's something there. But at that time, we were perceived as the thought leaders on the space. We probably were the thought leaders on the space. I mean, we certainly weren't the only small company pioneering this space, but we were one of them, and we were well respected and perceived as one of, if not the best at doing this. So when you have 5 incumbents realizing that they need to be this in the space, and one startup that is kind of way ahead of the curve on this, that's a great environment to try and get acquired in. And we were not oblivious to this. And so in 2018, we kind of started what I describe as the flirting or mating rituals with all these incumbents, where we would start having conversations with them about our desire to kind of maybe work more closely with them, to maybe leverage their reach, leverage their distribution channels, and they can leverage our data science abilities and our product offerings. But it was really a mating ritual. It was a flirtation thing where I was really looking for an expression of acquisition interest, and they were trying to see, look, can we just buy these guys? But yeah.
How big were you at this point? Like, just proxy for size of some sort?
Well, I mean, the only thing I say on that is we're about 80 people, 75 people. I can't talk about the revenue numbers or that sort of thing.
That's okay, but that'll help people get a proxy for size of company. That's great. So you're roughly 75 employees, and you're doing these sort of, in your own words, flirtatious conversations. Love that, with the big data provider. I mean, data provider. So I'm thinking, like, it's the ones I'm aware of are like Thomson Reuters and Bloomberg and Nasdaq, and those are the kinds of players you're having these sorts of conversations.
Exactly.
Now, again, when I'm thinking about that, I'm thinking, wow, those are delicate conversations. And again, a lot of our listeners would be terrified to go and approach their giant 800-pound gorilla in their industry and start having these conversations, because they'd be fearful of revealing too much about their proprietary sort of secret sauce to their giant competitor. How did you think about those conversations so that you could, look attractive without giving away the proprietary data or the information that they could use to compete with you?
Yeah. So, I believe, I mean, I can only speak about my space, but I've seen this at least in the 2 or 3 industries I've worked in my career. The devil is always in the detail. So I could spend the next hour and a half or 2 hours telling you everything I know about the alternative data business, everything I've figured out, and your work is still all in front of you if you want to build a Quandl competitor, right? It's all about the execution. It's all about all the dumb little things that you encounter day to day. How do you get people over the line to give you their data? How do you market the thing? What do you put on paragraph 3 of your marketing brochure? Like, it's just, there's so much details you have to get right. So I just simply wasn't worried about that. I think like I've been in business for 25 years or something like that. When we were in the hedge fund world, we'd have investors come in and say, "Oh, tell us about your strategy." I tell them everything. I'll tell you everything because all your work is still in front of you. I mean, you got to do the 60 hours a week for 5 years, and then you'll have what we have, right? So this is my philosophy on this. I could be wrong, or maybe it's only true for my industry or my space, but that's my life experience on this. So I wasn't worried about it. I built relationships, by the way, with all these firms. You bump into them at all the conferences over the years, and you get to know the people, right? And you have a beer with them innocuously, and it just so it was a very natural progression to start, talking a little bit more about partnerships and not really. Well, it certainly wasn't intimidating because I had nothing to lose, right? It was just, hey, let's talk about this, right? It's not like we hadn't been talking about this stuff. You're always talking to people in your space. Oh, what can we do together? What's something symbiotic? So, yeah, it was quite natural.
So these conversations about what could we do, how can we partner together, how can we work more closely together, these are all sort of veiled or code for would you like to buy us? At what point did somebody see through that veil and say, Tammer, are you looking to get bought?
Well, that was a pivotal moment, actually. I went for drinks with someone from Nasdaq. We had a bunch of drinks, and maybe it was 3 drinks in that he said, "Look, crazy idea for you, Tammer, but what about maybe think about an acquisition?" And of course, I was like, "Oh, I hadn't thought of that." But he knew, I knew, we all knew what was going on there, right? And then it started for real. Like that's when, a few weeks after that, I think we had maybe a call, or I think he maybe came to Toronto. We started talking seriously about, once he sort of crossed that line, then you can really start talking. And we very quickly started talking about numbers. I think he understood our business pretty well already because Nasdaq was already kind of in that space.
And what were the numbers he was most interested in knowing in those early conversations? Revenue, churn, those sorts of numbers? What other data points was he interested in?
It was the kind of the big picture numbers, right? How many customers, how much revenue, how many data sources, and very importantly, how much to buy you, right? We started talking about that number quite early. In fact, before we did anything formal, I think we went back and forth for months on just that number. What's the sale price for Quandl? What's that number going to be, right? To put it in perspective, I think I had that. Those drinks would have been in the spring, in March or something. And we weren't into a formal acquisition process till September. Like it was sometime in August that they actually sent us a letter of intent. And then we got into the nitty gritty through the fall.
How did you stick handle those conversations around what's it going to take to buy Quandl? Like, did he make the first move? Did he ask, okay, well, what do you want for it?
Yeah, it was an unoriginal negotiation in that he said a low number, we said a high number. And then, he went up a bit, we came down a bit, and we eventually arrived at a number.
And what was informing your number? Like, were you looking at SaaS company benchmarks or information company benchmarks? Or like, what was the benchmark that you were pointing to saying it's worth X?
Honestly, I was looking to maximize the number. I was, I had determined that it was a great time to sell. I wanted to sell the company. Another thing to keep in mind here is, so I've been working 8-9 years on this thing. And as every one of your listeners know, entrepreneurship is hard as hell, and it's hard as hell every single day, right? And when you're doing that for nearly a decade and there's light at the end of the tunnel, I wasn't going to let that, I was going to get out of that tunnel. I was going to get to that light. And so I was just going to, how high can I get these guys? And whenever we top out, I'm going to do it. right? I'm going to do it at that price. So that's how I went about it. I was definitely in a mindset that here's an exit opportunity. It's going to be a good outcome for everybody. So my job is to get us there. So
did they make the first move over kind of casual conversations? Like, did they say, well, what about X? And then you went back with Y, or did the inverse happen? Did you start with Y?
No, so I think no, you know what? We might have said the very first number. I have this recollection that the very first time Nasdaq came to visit us, at the very end of the meeting, someone asked one of my colleagues, what's the number? One of our advisors actually, what might that number be? And we had been expecting that, and he planted a number. He said a number, and I actually remember the reaction was he kind of nodded solemnly, and he said, "Oh, that could be difficult, but I'm going to see what I can do." Right, and so that was kind of how it started. And then they came back with their number was like 1/3 of our number. Right, and is what they came back with, and then off we went.
Yeah. So theirs was 1/3 of your number. How close in the end did you get? I know we can't talk about the actual number, but how close did you eventually get to the number that you'd thrown out in that meeting?
You know what? We came very close to meeting halfway between their first number and our first number in the end.
Interesting. Interesting.
Yeah. And like I've done precisely one deal in my life, so I don't know if that's kind of how it always goes, or that was just the way it went for us. But that's what happened. And yeah.
How did you know there was more in the tank? So for some people, when you're that far apart, the temptation is to kind of cut bait. And so there's no way this is going to work. You want a third, your offer is like 1/3 of what we want. So they cut bait, but you stuck with it. How did you know there was more room there?
Yeah,
and that was just their first foray.
Yeah, it's a good question. I didn't know, of course, for sure. I never knew. I mean, they might have never called back after, but the fact, I think, I don't know, but I would infer that maybe when they came back with their number, they were already thinking, if we meet halfway between this number here and the number Quandl said, that's going to be acceptable to us, right? So they might have actually thought that through in the first place. But the other thing I haven't mentioned is they were not our only suitor. So we had a second suitor, which made, infinitely stronger position as a company trying to sell itself when you have two suitors. And so all the time we were doing the dance with Nasdaq, we were doing the dance with this other organization as well. And I'll tell you an interesting thing. Both those organizations sort of came at it the same way. They're same kind of numbers, same sort of way they were thinking about it. And way down the process, when we eventually had to choose between Nasdaq and this other organization, you wouldn't believe how close the two numbers were. They were within 1% or 2% of each other.
What do you attribute that to?
Pardon?
What do you attribute that to?
I think that the analysis both companies were doing in terms of what is the impact to our business of adding Quandl was probably the same. Because our impact, when you think about it, if you insert Quandl into Nasdaq or you insert Quandl into, Bloomberg or FactSet or Refinitiv, the impact is probably going to be about the same in terms of what it opens up and what it achieves for them. So it kind of makes sense to me in retrospect that they got to the same place. But it was just interesting because, I had this thought that, I'll get them playing off against each other. I'll go to one and say, well, the other guy's at this point. But they both just stopped. They both were like, no, that's it. If the other guy goes higher, I can live with that. It was really interesting.
How did you have that dance without angering the other side? Because it feels like a very delicate conversation. Because on one hand, you would have a long-term working relationship with this company. If they acquired you, there might be an earnout, et cetera. So you've got to have this sort of like good relationship with them. And at the same time, they see you using their offer to gin up another offer. It can often anger them, right? And saying, hey, we don't want to be in an auction here, Tammer. So if you're interested, great. If not, let's call us a day. So how did you do that without angering the other side?
So the truth is, they are far less emotional than me, right? For me, this is my whole life. I spent 10 years on this thing. It's going to, life-changing money if it's successful. For them, it's yet another acquisition. They've played this game. They know how the world works. They know it's competitive. And we were, like both my partner and I, we're not kind of grandstanders. We're not jerks. We're not assholes. We were always polite and kind. And ditto for Nasdaq, more so. They were so professional and so transparent. It was, there was no nonsense. And so it was a very civil discussion. And at the end of the day, they understood that we were obviously trying to maximize the value of the company. And so there was no, that didn't materialize, that sort of anger situation.
How did Tripp feel about you selling?
My VCs were supportive. I mean, I couldn't sell if they weren't. I mean, they have, part of the deal with taking VC money is, they kind of have a lot of power that way. I mean, at the end of the day,
they had a seat on the board, and did they have veto rights when you went to sell?
Yeah, sure. But I mean, veto rights in VC world is a bit tricky, right? Because they could veto it, but you don't want to discuss unless you can replace the founders with another CEO. I mean, it's kind of a poison pill, right? But like I say, Tripp was, not only very supportive, but he understood that this was probably a good price at a good time. And so it wasn't going to be his 10x return the fund kind of investment, but it was, it's going to help the cause, right? I mean, it's a profitable investment for him, right? So he's just sensible, rational, and supportive.
And what benchmarks was he giving you, saying, Tammer, like, this is what I'm seeing in the world of, data sets, information products? Was he giving you any sort of sense of what it could be worth?
Nobody knew, right? There's no, we're a new kind of business in an industry, this alternative data industry, but there was no such thing as that thing 5 years ago, right? Or at least. But
you could have looked at Thomson Reuters, a publicly traded company. You could have looked at their multiple, or Bloomberg or Gartner Group. These are all information products, all New York Stock Exchange listed companies, I think.
Yeah, I mean, you could.
Weren't there benchmarks out there you could have turned to?
True, yeah, there was, but the interesting thing there is, we have this concept in finance called price discovery. So you can do all the math you want or all the analysis you want, but at the end of the day, the market is going to tell you the price. And when we had two companies kind of arrive at the same number, it means way more than all the analysis you want to do in the spreadsheet. Do as much as you want. At the end of the day, the market seems to have decided that this is what you're worth. And so that was kind of the thinking.
What impact did that have for you and Abraham as shareholders, as founders, when the two public big acquirers came roughly within 1% of each other? Like, what impact did that have on your commitment to the deal?
Well, you know how it helped a lot, because, if we had, let's say we'd only had one, we would never know if we had sold too cheap, because maybe we could have just dug our heels in the ground, waited 6 months, and they would have come back at, 20% higher or 30% higher. But when you have a second bidder, and they're both aware of each other, and they're both still saying, this is the most I'm going to pay, and I know you have somebody else, and I've come to terms with the fact that we're going to lose the deal, it really tells you, okay, we found quote unquote fair value for this company. And so it kind of helps me. I don't want to say it helps me sleep at night, but it gives you some certainty that, yeah, you know what? We got the most we could get for this business.
And I'm hearing, if I heard you correctly, that both companies eventually tapped out and they said, that's our final offer. And if you can get more elsewhere, Tammer,
good luck to you.
Good for you.
Totally. 100%.
Yeah. That's helpful for sure. Well, congratulations. It's an amazing deal. Nasdaq is an incredible company, obviously, and an amazing acquirer. Are you up for a quick lightning round?
Yeah, let's do it.
Okay, cool. I know you talk to lots of people, investment rounds and acquirers. And so when I ask this question, I'd ask you to just cast your mind to all the way back to the earliest days of raising that first round of friends and family money right through to the Nasdaq acquisition. What was the slimiest, dirtiest trick an acquirer or investor tried to play on you?
Nothing whatsoever. Nasdaq was the most... They were fair, they were transparent, they were straightforward, they were honest at every single point of the negotiation. And actually, one of the traps I fell into was thinking, they can't be this nice. They can't be, there's got to be something, they must be playing me somewhere here. But no, they were just, and it makes sense to me now because once I spent 2 years inside that organization and I learned how much Nasdaq values integrity. It's so important for their brand. And, they're not going to compromise integrity to save $1 million on a deal. It's just not, it makes no sense in the long term. So it's a testament to Nasdaq. It's also a testament to the individuals at Nasdaq who worked with us through the process. They're just decent, hardworking, honest people. So I have no, one slimy story. We once had a competitor dress up as a customer to try and glean, insights about how we're doing stuff. That was about the sleaziest thing we encountered over 10 years.
When you think about the sale process itself, when you started to have those flirtatious conversations all the way back in March of 18, through to the closing, what was the low point emotionally for you where you reached a kind of real bottom?
There were two things. One is what I sort of alluded to, the fact that I thought we were playing a much more sort of sophisticated game than we were. And so sometimes, one time during the negotiation, I took a hard line on something just because I thought that was what you do, right? And it almost blew up the whole deal. Just because, and Nasdaq had been honest and straightforward, and they said to us, look, Tammer, honestly, this is really important to us. This is really important to us. And I was like, oh, okay, well, it's really important to us, and I'm going to, fight this. And it was just so stupid of me. It was so stupid. I thought it was, it's a funny little metaphor, but this expression, one guy's playing chess and one guy's playing checkers. Well, it's the reverse here. Nasdaq was just playing checkers, and I thought I was in this complicated chess game, and I wasn't. And so I almost shot myself in the foot. So that was a low point, a sleepless night when I almost blew up.
Are you able to share what the point was that you were digging your heels in?
You know what? It was something about working capital. How much working capital should be left in the company? It was just. It's just stupid of me. I mean, so Silicon Valley has one view of how working capital should be handled, and the East Coast has a different view. And it was just a religious thing. Silicon Valley thinks about it this way, and I'm being advised by 2 Silicon Valley VCs, and New York finance companies think about it this way. And so, it's not a big deal, but the fog of the deal, and I'm placating lots of parties, and some people in a negotiation want me to push for more money, and some people want, and so I just played it wrong. I just misread the whole thing, and I almost blew up the whole thing. And I called, and again, to Nasdaq's credit, I called them back the next day and said, my bad, I screwed this up. And my counterpart there said, yeah, no, okay, all good, let's keep going. Like just class, right? So, that was probably the low point.
For our listeners, could you describe how Silicon Valley VCs think about working capital and how East Coast finance types think about working capital in a deal?
So this will underscore just how pathetic I was that I made a big deal of this, John? I don't even remember. I can't remember any of the details of that.
Yeah, got it. Okay. What about the emotional high? Well, describe for our listeners the top of the mountain. Where were you? What was the emotional high associated with this?
Oh, for sure. It was the day the lawyer called and said, Nasdaq has instructed me to release the signatures, which is basically code for deals done. And I was instantly, what a relief, right? When I'd been in this process for 9 months. And the thing with acquisitions and even raising VC money is, so we had an agreement in whatever, July or August, in principle, what we're going to do here. And then there's 4 months of diligence. And the only thing that can happen is the deal falls apart. That's all that can happen and so every single day, and Nasdaq, again, to their credit, was very, very thorough in their diligence. Spent a lot of time with us, looked at everything. So on every single day, all I could do is go from being successful to being a failure, right? That's all that could happen in those 4 months, right? And so it's, that when we finally got over the line and it was like done, it was like such a tremendous relief. That was by far the high.
Where were you? Can you describe sort of like who you were with, what the environment was when you got that phone call?
It was mid-morning on a Friday, and we were supposed to close that day. So it wasn't like and I'm just sitting there, and I was just sitting at my desk watching the second hand go around, waiting for something. It was just that. And so then the phone rang. It was my lawyer, and she said, I'm just calling to let you know that Nasdaq has asked me we've been instructed to release the signatures, which, means it's done. And then, you can't even describe it. I mean, it's like the professional high of my life. I will never have a day that good again. I can't imagine in professional aspects of my life.
Is that hard to reconcile with now?
I'm sorry, is it hard to reconcile?
Is it hard to reconcile with, let me ask it a different way. As a few years have gone by now since that moment where your lawyer called and she said, okay, I've been instructed to release the signatures. So you've come to realize that you will never likely have that sort of emotional high as you had. And that for a lot of founders can be hard.
Yeah, I'm okay with that. I mean, listen, there's not a day that has gone by since then where I'm not grateful and appreciative of the situation I'm in now, right? I mean, I'm in a very good place. I got nothing to complain about, John. I mean, I'll find some things to complain about, but I know no business complaining. I'm in a really good place. So I appreciate it. Like, I was euphoric for weeks after that. I mean, it was just, I was so happy. And obviously, I wish I could have that feeling forever. But, you get used to this new normal, which is it's a delightful normal. And like I said, I appreciate, always appreciate it. But I'd love to do it again. I mean, don't get me wrong. I would love to, not so much. I mean, an exit one day would be great too. But, I did this once. And it was difficult and terrifying, and I made 10,000 mistakes, but eventually got to the end. I would be so tempted to do it again because I'm almost certain I can do it better the second time, right? If I find the right thing with, the right opportunity.
Yeah, that's one of the things I say to young founders. I say, go through an exit because you'll make all the mistakes in the world the first time, and then you'll have plenty of runway to go do it again, and then maximize whatever. So I'm a big fan of having a training wheels business and exiting it and moving on. Were there resources that you turned to, Tammer? Books that you could point our audience to, or courses, or anything that you could sort of point our listeners to in the way of tools to help them get ready for an exit?
Short answer is no. I relied very heavily on basically my partner, Abraham Thomas, who is exceptionally knowledgeable about all things entrepreneurial, and Trip Jones, who's for him it's just another acquisition, right? He's done it a whole bunch of times, and he kind of coached us through it. So it was those two people who I relied on the most. I'm for better or for worse, I tend to be more about just dive into the deep end and figure it out as I go, as opposed to studying the literature.
Yeah, when you get the new bookcase, you throw out the instructions and just start assembling.
100%.
Got it. Last question. Tell me about the trophy you bought yourself to commemorate this win.
Okay. So I have two kids who were toddlers when we started Quandl. And over the years of Quandl, they would ask me some things. And very often I'd say, well, we might do that one day if Quandl's successful. And it became this thing is, if Quandl's successful, good things will happen. So they didn't know what that really meant, okay? Because they're just little kids, right? And so, when we sold the business, I was over the moon, as I said, and I wanted to find a way for my kids to experience that happiness, right? And one of the things I had said that we do if Quandl was successful, not that we couldn't afford it otherwise, but there's a tower in Toronto. It's called the CN Tower, big second or third tallest tower in the world, and
was the tallest for a period of time.
Yeah, it was the tallest for a while, right? And it's a touristy gimmick, but my kids had said, oh, let's go. There's a restaurant that revolves. And I said to them, oh, if Quandl's successful, we'll go to the CN Tower. And so I was like, okay, we're going to the CN Tower. And so that was the trophy. And I spent, for a family of four for dinner. My father-in-law was there, 5 of us. It was like $600. The chicken fingers were like $50 for the kids' menu. It was ridiculous, absurd. But that was my trophy. I indulged on a kind of corny dinner at the CN Tower with my family.
You got off cheap, buddy. That's great. They'll remember that dinner for life, I'm sure. They better.
Totally.
Oh, well, this is great. I'm so thrilled that you got to the CN Tower and they got to experience that. That's great. Well, listen, I know people are going to want to reach out and say hi and get to know you. What's the best way for them to do it? Are you a Twitter guy or LinkedIn, or what's the best?
Find me on LinkedIn. I'm always keen to have conversations about entrepreneurship. It'd be wonderful.
Fantastic. And so we'll put Tammer's profile link in the show notes at builttosell.com, and encourage you to reach out and get to know Tammer. Tammer, thanks for doing this.
That was a lot of fun. Thank you for having me, John.